Episode 74. Richard Nixon was the first president to resign from the White House. This happened in 1974. The 70s bear market bottomed on December 6, 1974, and this blew my mind. It wasn't until 1974 that women in the US could apply for credit cards in their own name. Beyond MD, episode 74, here we go! Hey everyone, welcome back to the show. Today we dive back into private lending and specifically with a focus on mortgage investment corporations, which we will refer to from here onwards as a MIC, spelt M-I-C. So a MIC is essentially a pool of mortgages that one can invest into. And this is one type of a fixed income investment strategy. Now, my guest on the show today to help us understand these investments is Arjun Saraf. So Arjun is an accountant by trade. He's a CFO and CCO of New Haven Mortgage Corporation. And if you remember, I did have him on the show previously. It was back in the day on episode number 12. So if anyone is looking for a quick refresher on MICs, that would be a great episode to go back and listen to. Now, that was back in the day when the overnight interest rate in Canada was just 0.25%. Since then, obviously, the interest rate jumped many times, reaching an overnight rate of 5%, which is the rate that it was when I interviewed Arjun back in May of this year. And since then, we've had a few cuts. The overnight rate is now down to 4.5%. But the point of all that is that today, MICs are facing a very different landscape. MICs and their borrowers are facing far more challenges than they were back in 2021 and early 2022. So today's episode is going to focus on understanding this investment strategy. We want to understand how a MIC works, what the risks are with a MIC, how a MIC can mitigate that risk, some of the very key questions that we must be asking when deciding, is this investment strategy right for us? And back in the day, when the overnight rate was just 0.25%, people weren't getting much of a yield on other fixed income instruments. Today, though, think about it, you're getting nearly 5% risk-free. So how does that weigh with a MIC? All important questions to be asking. Now, I want to be as transparent as I can. A MIC is something that I do invest in myself. So the fund that Arjun discusses, I invest in that myself, but I only did so after going through the strategy in a great deal of depth and asking all of the tough questions. And you're going to hear some of those tough questions today. And remember, don't invest in something because I invest in it or somebody else invests in it. You have to figure out what's right for you. How do you want to diversify your own portfolio? And what steps do you need to take to reach your own goals? So guys, that's enough with the intro. Let's get on to my interview with Arjun Saraf on mortgage investment corporations in today's landscape. Arjun, welcome back. It's good to have you back, man. How are you been?
Thank you. I've been good. It's been challenging for the past few years, but lots of things have changed, lots of exciting updates, and I'm looking forward to sharing some of them with you.
I've known you for so many years. Do I pronounce your last name right, or do I not get it?
Go for it. Let's hear what you got to say.
Well, I've been saying Saraf, but you say Saraf, right? Isn't it?
I don't know. I kind of adapted to the crowd. I'm not too particular. It could go either way, right? Saraf.
Well, okay.
Saraf.
Oh, interesting. So, guys, Arjun is back on the podcast for the second time. The reason I thought it'd be really interesting, Arjun, to have you back this time is when we did our first interview on mortgage investment corporations on MICs.
So
that was back in a very low
3 years ago. Right?
Yeah, it was 2021, I believe. 2020, 2021.
That was before 2021, you were a famous star, though.
Yeah, whatever. So it was a very low interest rate environment. The overnight rate was 0.25%. And as we know, we're now up to 5%. So I imagine the landscape has changed. And guys, the reason I wanted to have Arjun back, it's because not only is Arjun my friend, but I do ask him a lot of questions on this investment. And my belief is that I'll get answers and information from Arjun that I probably wouldn't get from everybody. So it's really good insight into this strategy for those people who are just wanting to be more curious. That's why, Arjun, I wanted to kind of have you back on. So I'm excited to talk. And listen, I've been following you on social media as well. We probably should meet in person more often, but I see you meeting with a lot of important people, a lot of influential people. So the fact that you're making time for the common folk like myself today means a lot to me. So
here we go. Buddy, I just live in your shadow. That's it.
Yeah.
That's all. I've been pining for a chance to get back on this for a couple of years now. The wait list is long. Sign
well,
up now,
well,
everybody.
like
You'll get your shot.
like they say in life, all good things take time. So, so Arjun, tell us.
Absolutely. And one thing I appreciate about you, Yetan, is that your insight and your development of this pod and the focus that you've had and the education that you provide everybody, I think it's fantastic. And then the variety and number of topics that you cover and you personally study yourself is very impressive. And I'm glad to have this opportunity to chat with you.
Arjun, thanks so much. I really, really do appreciate that, genuinely. Maybe tell us a bit about yourself professionally. We'll leave the sweatpants world tour out of this one, but tell us a bit about yourself professionally.
Professionally, I mean, first and foremost, I think I'm just an employee of my daughter who pretty much rules the roost. Outside of that, I I run a mortgage investment corporation. Uh, I'm the CFO and CCO of New Haven Mortgage Income Fund. My background professionally, I'm a CA by trade, focused on growing businesses, processes, and specializing in the mortgage investment space. I also am an exempt market dealer. So the exempt market is basically an opportunity to put together private investments with investors that are looking to diversify into different types of products. My focus is really real estate because that's what I know and that's what I feel my expertise is in. And also, I am a mortgage broker by trade, and I am the principal broker of New Haven Mortgage Corporation.
That's amazing. You have a lot going on, but I do like that you know where your expertise lies and you seem to stick to your lane. So tell us a bit about the Mortgage Investment Corporation of New Haven, the MIC. Tell us how it's structured. Give us a quick overview.
Sure. So we are 100% on Ontario. We focus on residential mortgages. We do have plans on expansion, but obviously our plans were put on hold given the current environment. We are separated out into two share classes, and we have our MIC O share class, which pays 6%. But the difference is that the MIC O goes up to 55% loan to value. And when I say loan to value, it's if a property is worth 100,000, MIC O will only lend up to 55,000 of that property. MIC D, which is our new share class, is focused on up to 80%. But realistically, in this environment, we don't go past 70% all that often. Considering the last few years that we've been through. We've really changed our strategy with that. And our main goal is to provide short-term solutions for borrowers in the form of 1-year loans for the most part, and long-term investment solutions for investors. Slow and steady is our focus. So we pay our dividends monthly. Our returns in our MIC C class are around 8%, and we focus on the long term for investor growth, and again, short term for borrower solutions.
I love it. We're going to get into why you don't exceed a certain loan to value shortly, but you also initially, when we first talked, you described your MIC as being equity-based lenders. Can you tell us what that term means and why that's important?
So equity-based lending is really focused on the marketability of the underlying asset. So your primary goal is to figure out, if God forbid the borrower doesn't make their first payment, do I have a viable exit strategy out of this property? Which is why we focus on the loan to value as an important factor in determining that, right? If you're lending up like the banks do to 90, 95%, that leaves little room should the market have to correct itself. So because our borrowers are not your typical bank borrowers, they look for solutions like us where they have equity in their property, but need time to build their credit or need to get things in order to be able to qualify for a B lender or an A lender, the banks or the trust companies. And we are able to provide them that, but we obviously want to protect our funds and make sure that we have a viable exit strategy. However, in today's environment, true equity lending doesn't necessarily exist in its purest form, because now what we've done is when we underwrite properties, we don't just focus on the marketability of the asset. We also focus on the story of the borrower, their income, their credit. Does their story make sense? Do they have an actual exit strategy? So say the market stays consistent or it goes down. Is this person, printing flyers and claiming to make $400,000 a year with a 400 beacon score? Does that really provide us an exit strategy, no matter what the loan to value is, right? So I would say that from 2010 to 2022, barring small changes in 17 and 18, you're looking at a time where the market was continuously growing. It was continuously escalating. So being an equity lender at that time in its purest form was a lot easier. But today you cannot view the property or the loan as just what the property is worth. You have to see and focus on credibility of the borrower and build a risk assessment based on both factors, and then determine what your comfort level is on doing the loan.
Is it safe to say, Arjun, that the hybrid approach here, focusing both on the property and the borrower, you are now obviously thinking a lot more about the borrower, but that's been a change that has occurred maybe in the last couple of years with rising rates? Is that kind of what's happening?
Absolutely. As the market stagnates or properties go down in value, you are focused more on where the loan will be on your books and how long it'll be on your books.
Arjun, one thing I do want to better understand is interest rates have gone up steadily from Q1 of 2022 until the summer of 2023. And that's impacting everybody who's trying to take a mortgage, especially a variable rate mortgage, out of the bank. But what I'm trying to better understand is, how does that dictate the rates that your borrowers are paying and then the returns in the fund? That's something I'm not totally clear on.
So our rates are based on the loan to value that we're lending on. So it's obviously a sliding scale. For us, the lower the loan to value, the better. So we charge more favorable rates on the lower end. We look at the borrower, like what risk we're taking with the borrower. Our lending environment is depending on the deal that you're trying to achieve, right? Because in the private space, in general, in the last couple of years, the market has taken off. Like, you have lenders providing loans for 20% plus a 5% fee, right, on one end. Now, if you really are looking for product that is viable in our space, you're looking from the 8% to the 10 or 12% range in terms of rate. Mm-hmm. And the reason why I say that is because when you're taking risks at 20% plus 5%, the chances are the borrower doesn't show any income. They're probably coming out of a power of sale. They're in a desperate situation, and they're willing to sign anything to kind of stay in their house. And that is not really a market that we want to focus on, because that, unfortunately, we view as predatory, right? You're taking advantage of someone in a situation that isn't able to help it. Now, if you want to focus on quality product for self-employed people that are that may not qualify for the banks as a whole, because their income is not on a T4, as an example, you're looking at us factoring their rates in from the 8 to the 12% mark. So again, you're looking at loan to value, you're looking at the borrower, and you're also looking at the market, what it dictates, because everyone's competing for that type of product in the mixed space, right? We all want the borrowers who are well qualified, have a perfect house and in great state of repair that we can lend up to 60 to 70%, and at the end of the day make a reasonable profit and give good returns to our investors, but also manage the risk side as well.
In your opinion, is the MIC landscape, is that still a good area to to be in business in? Because I'm wondering if there are more players coming onto the market. You're competing for the same borrowers. What are your observations there?
I think the MIC space is a very good space to be in from a business perspective. There is something to be said about organized lending and organized investing, right? The private market that people invest in, where they're not really verifying the products, they're going through a third party that's promising them X return, and they're not really doing their due diligence or underwriting themselves. I think there's a danger there from compared to when you're investing through an organized vehicle. Now, for us, that holds us accountable to doing the work that we do, and the fact that we go through our audits, we have bank reporting for the most part for facilities. Our aim is to grow the fund and to provide this type of investment vehicle for investors for the long term. So that is very rewarding, and also managing our risk at the same time and providing short-term solutions for the borrowers. Now, there are a lot of new players in the space, but MICs that have been around a long time have established track records, have established strategies, have been able to pivot during this last 3 years to be able to sustain for the long term. So does it have its challenges? Absolutely. But what industry does not have its challenges, right? Does it have competition? Sure. The MIC space has increased in the past 6 to 7 to 8 years, where we have a lot more MICs that are popping up. But I maintain, if you stay within your box, you do not move one way or another, and you focus on your strategy, you can and will provide long-term benefit for investors and for yourself as a business owner, because people put their faith in you, and you can reward that faith by operating and focusing on preserving their capital and giving them long-term returns that will benefit their overall portfolio.
You mentioned, in terms of returns, 6% on the lower end right now, 8% on the higher end. You also mentioned the term dividend. I just wanted to clarify, these returns are treated like regular income, right?
They are interest income. So
interest income.
Yeah, so they are treated as interest income. So even though they're classified as dividends under 130.1 in the Tax Act, they're it's a flow through, so they're taxed in the hands of the shareholder. An investor, they receive preferred shares, and then the returns less the cost to run the fund are returned on a monthly basis to the investors.
As you know, Arjun, there would be times in the last few years where I would see something published, maybe in the Globe and Mail, and I would bring it to you. I'd be like, hey, Arjun, look, this MIC's in trouble. Like, there are some disturbing trends here. I want to better understand what has happened in the last few years. One thing I do want to know is, what's the trend and current observation in terms of the loans that are not being paid back by borrowers? What are you seeing there, and what direction is this heading in?
I'd split this up into kind of 2 or 3 time periods, right? So over the 2023 year, I would say that arrears and challenges for borrowers were at an all-time high. Q4 2023, you're looking at higher arrears, challenges with financing. Nobody can refinance out because the market had kind of bottomed out for the most part. And the rates had already increased so significantly in an unprecedented manner that, throughout history, we've never seen before. And I think the combination of all those made arrears and, created arrears, and people were walking away from their properties back in 2023 because, if they put a $200,000 down payment and that was wiped out on properties that were significantly overvalued during the peak in the first half of 2022, they had no choice, because to pay the mortgage payments that they couldn't afford, to maintain a house that the value has dropped and all their equity was taken away, resulted in, it did not benefit the borrower. It was easier for them to kind of walk away from some of the properties than to try and hold on to it. Now you're looking at, in this year alone, you've had two different cycles. One, you've had the cycle of the market picking up again, where real estate was selling. There were, bidding wars again. There was financing clarity. So people had adapted to the high interest rate environment for the most part, and they weren't waiting on the sidelines. Then you also have the lull in the market, where people are also waiting for interest rates to go down. Because, in the last few weeks, what you'll have noticed is that people are anticipating that in June or July, the Bank of Canada is going to cut the rate. So they would rather wait for that to happen than commit to buying a property during this time, during this cycle just before the interest rates are supposed to drop or should drop. But again, that's up to the Bank of Canada. But arrears definitely increased in 2023. And what we're seeing in 2024 is a drastic improvement from what 2023 had to offer. That being said, there's still challenges in mixed portfolios. We were at the Alternative Mortgage Lenders Conference that was thrown by Bank of Montreal. And, there's the national average is about 10-11% for arrears. So
okay, so just clarify that. That means that 10 to 11% of loans have not been paid back. And this is current, or was this Q4 2023?
This was Q4 23, Q1 2024. So
wow.
You're looking at the banks who provide facilities or lines of credit for a lot of mix. And, the one thing that you've noticed, and people can't, escape the fact that if the banks have arrears, all markets will have arrears. If the banks, take losses or write down part of their portfolio, all real estate investments in the residential market during the 2022 period would experience similar types of challenges. Now, the good thing for us is that we're focused on loan to value. So because we're a lesser loan to value, we have more of a cushion to adapt from, how the market changed. And what we've seen is that, have we taken losses? Absolutely. And anybody in this period who's lent in the 2022 market that tells you that they haven't experienced a loss of any kind, I don't know how that's possible. Mm-hmm. They may have a loan loss reserve, which of course is built up, but the times in 2022 and 2023 were extremely challenging. However, if you stuck to your guns, you stuck to your underwriting process, you didn't go out of your investment strategy, you're able to pivot and maintain for the long term. Yes, you would have hit bumps in the road, but you're able to carry on and sustain yourself for the future.
10 to 11% arrears, is that the highest that you've seen?
Absolutely.
Okay. Today, has that trend improved?
It has. So speaking from our experience, we are currently in the 6 to 7% range. Historically, our average has been, 3-4%, I would say, okay, at any given time. Obviously, we're in a different industry than the banks are. So it's granted that there will be arrears on our books based on the risks that we underwrite to, right? It's hard not to have some form of arrears.
Arjun, I just want to say, I really appreciate you being so candid with this information. This is what I try and tell people. I don't think it's always easy to get access to this information. I appreciate it. I know the listeners will appreciate it. And I know that you are very open, very transparent. I do think that goes a long way with people. So I just want to acknowledge that.
I think that, if one thing that we did during COVID was we enhanced our reporting. So, Yethan, you also have invested with us. So you may have noticed our newsletter where we've added reporting around our arrears. We've enhanced our reporting around our arrears. We talk about what stage each power of sale file is in, the amount, the days outstanding. So we've added that in because we feel like for investors, transparency is above all. Sure, people may not appreciate it, but in the long term, it's the only way to be and it's the best way to go.
Yeah, so I didn't make that clear initially, but yes, I do invest in Arjun's MIC. The reason I go this route is, for me, it's really important to have access to information. And Arjun, I know that knowing you allow that to be possible. So it makes me feel a lot more comfortable with the investment process and allows me to take the necessary steps with more conviction. So again, that is so key. And I think it goes a long way with investors. I don't want to spend too much time on the next question because I know people talk about interest rates all the time. And while it's important, it's really hard to know what the Bank of Canada is going to do. But I do think your take is interesting because you live and breathe this stuff every day. You're talking to a lot of people. You have eyes and ears on the ground. What do you think will happen for the remainder of the year when it comes to interest rates?
It's hard because, you don't have a crystal ball, but my anticipation is that we'll probably reduce rates around 3/4 of a point up until the end of the year. And I think long term, over the next two years or 2.5 years, we'll probably settle somewhere in the mid threes in terms of what the interest rates will be long term. But that's given other macroeconomic factors remain relatively consistent because, there are other factors in the economy that would have an impact on this, right? Mm-hmm. You're looking at, taxes, immigration policies, how small businesses and the middle class in Canada are surviving and how they're doing, and to make sure that we're not losing that aspect of our economy.
Appreciate that. You are probably a little bit more optimistic than me. When it comes to this stuff now, I've learned over time to just give myself more buffer room because I have made mistakes with my projections, being too optimistic on interest rates. That's why I tend to be more a glass is half empty kind of guy when it comes to this.
Absolutely.
I was thinking and what I anticipated was that they would not start to cut until Q2, Q3 of this year. I'm thinking maybe 2 cuts, but we'll see. I really appreciate your perspectives though. Now,
yeah, so you're anticipating half a point basically up until the end of the year.
Yeah, absolutely. But again, we have more debt in Canada per household than we do in the States. The reason I'm a little bit cautious is that if Canada started to cut rates a lot faster and a lot earlier than the States, that would have a negative impact on the Canadian dollar. And I know that's not what they want to see. So that's another factor that I'm keeping in the back of my mind.
And that's what makes it so challenging, right? The macroeconomic factors, they're so diverse, and one aspect could improve, but that obviously that impact on the Canadian dollar is something that will impact Canadians in the long run, right? It's not something that's easily predictable. Don't beat
Arjun,
yourself up for not knowing what's going to happen, because anyone's guess is as good as anyone's. You can just read the data and make an educated decision based on what you're seeing in the economy. That may not be what ends up happening. There's also political concerns, right? So there's a political aspect to this. How do politicians spin interest rate reductions in terms of when the election's coming up next year? So, there's so many aspects to it. So I wouldn't be too highly critical on yourself for not being able to predict what happens.
Arjun, can you give us a quick summary? You've talked about this in your answers so far, but on ways in which your MIC mitigates risk? Because I think this is a key question for people to be asking. We're going to get to that as well. But summarize for us the key ways in which you guys mitigate risk.
During the change in the economy, what we did was we pivoted our strategy to a risk assessment model. So we took 5 or 6 aspects from the real estate side and 5 or 6 aspects from the borrower side. And what we do is we build a risk score. And what the score does is it determines, give or take, how much loan to value we would be comfortable accepting based on this borrower. So, one thing we look at that is different is we look at the score, we focus on what the exit strategy is and what the serviceability of the loan is. So, like I said, we talked earlier about this. So, you have a story of someone who's making $400,000 a year on a job that you realize they're probably not going to make that much money on. You have to look into it to see if that story actually makes sense. Now you have a real estate asset. What are the comps on that real estate asset? Because appraisals today, they require a lot of work and analysis that they didn't necessarily require in the past. So you have to look at comparables. Are the comparables time adjusted? What type of adjustments are the appraisers using? Are they looking at similar lot size? Are they looking at state of repair? Are they considering the location and how that impacts, rural versus urban markets? And I think that what our focus is in terms of mitigating risk is creating a story and a profile and a loan to value that we're comfortable with, and looking at our overall portfolio consistently and making changes. So how invested in the condo market are we? What is our max condos that we deal with? How invested in rental properties are we? Because generally owner occupied, there's pride of ownership. Rental properties, you have tenants who may not necessarily treat the properties as well. The landlord and tenant board, right? That's a factor. Because in Ontario, we have these ridiculous rules where people can pay rent or not pay rent for months and months and months. And somehow the owner or the landlord has to pay them to leave after they haven't paid their rent for 6 months. So, you have to look at where your exposure is in the market. So once you build that exposure in terms of how much of your portfolio you're comfortable putting in each place, each new deal that you do, you fit into a box in terms of the comfort level. So when we mitigate our risk, we take a step back, we look at our overall portfolio, we see how we're comfortable in what areas, in different cities. So cities like Brampton, as an example, they experience larger corrections than the city of Toronto. So you have to factor that into your consideration when looking at your overall portfolio. Now, looking on a micro level, what is this borrower's exit strategy? So are we going to get out of this property? And what will it take for us to get out of this property? Will they actually follow through on their plan to refinance? So when we mitigate risk, we factor in the macro and the micro, our overall portfolio and what we're comfortable with, and the individual borrower and the story and their property, and if we're comfortable with that.
On the micro, is there a maximum mortgage amount that you guys will not go beyond? Because the way I look at mortgages, there's the rate, but then there's also the volume of the mortgage. I'm just curious if that also is taken into account.
We built the model around what we're comfortable with. So we don't go over a $1 million first mortgage loan size. We don't, if we're a second mortgage, we don't go behind a loan that's under 750. That's over 750,000. We do not, we do not go over 250,000 for a second mortgage loan amount. So we built these boxes whereby, our model works and we maintain the quality of the portfolio. Now, we also look at if we're doing a second, does the first mortgage, has it already renewed at the higher rate, right? That's an important consideration, because if you're behind a first that is at 2%, what happens if the borrower has has to leave that fixed mortgage and now pay 6%?
Mm-hmm.
How is that going to impact the loan? What are the maturity dates for those loans? Do they line up? So there are definitely a lot of factors that we look at on the micro level to make sure that the loan is suitable and fits our criteria of how we view our exit.
So this is probably the most challenging interest rate environment that you guys have operated in. That's what I'm sensing. But what are some key lessons that you've learned about running your business, especially in a landscape like this?
Key lessons are to stick to your strategy. I think the one thing that people don't realize in a low interest rate environment where there's a lot of hype and the market is going crazy and you're seeing it all around you, everybody's doing 50, 60, 70 loans a month, and everyone wants to participate in that, and the real estate market is in a frenzy. If you don't maintain your underlying strategy and you get swept up in the market and what the marketplace is presenting, there will be impacts to your business because you've stepped outside that comfort box that you're in and you've deviated from the strategy that you've built your business on. So I think the biggest lesson that we've learned is to maintain our strategy. Slow and steady wins the race. We're not here to hit home runs. We're here to hit some singles, and we're here to maintain and sustain for the long term.
Arjun, what has the demand been like for your MIC? Because in today's environment, people have been investing in GICs, high interest ETFs. They're earning 5% with literally zero risk. And I'm curious, how has that translated into more demand, less demand for MICs? What's your take on this?
I mean, I think overall, if somebody were to say, if I have a guaranteed investment that's paying me 6%, does it justify going to an investment that pays 8%, right? And my answer is no. The additional 2% does not necessarily reflect the risk that needs to be taken to take an investment that's not guaranteed. That being said, this interest rate environment is temporary, right? So interest is not going to stay at 6% or 7% long term, one would think. Again, one would think. And once interest rates go down, the risk return ratio that's adjusted now, if we're giving 8% and there's a 3% guaranteed investment return, that spread is worth the risk, right? You're looking at investing in something that has now justifiably a higher return compared to what a guaranteed investment would be. Now, when you invest in a MIC like us, you're looking at the long term. You're not looking at the short term. We are not a short-term investment. We are the type of investment that you put money into your RSP or your TFSA, and over the long term, when you close your eyes and you open them in 10, 15, 20 years from now, your money has compounded itself consistently over a period of time. And over that period of time, when you look at how the investment has grown, it'll benefit you over that period of time, regardless of the environment that you're in. That's our focus as an investment. So today, yes, in the last year, 2 years, the rates have been higher, but over a 10, 12, 15-year cycle, that will average itself out. And being with us over the long term will justify making a decision to invest with us. And we have investors that see that because they don't focus on the microcosm. So demand has still remained for our product, but it has been impacted by the interest rate environment, right? Because if somebody were to ask me that question, I would give them a straight answer because that's, as you know, what I like to pride myself on. I don't want to sugarcoat it. I would rather give them a direct answer, but our focus is the long term, and we still get investors that want to come to us because they view that over the long term as a beneficial investment strategy.
I think this talk on interest rates is interesting, like understanding the long term trends. One site that I do encourage people to check out is Trading Economics, and you can quickly get a snapshot of how interest rates have changed over the cycles. Usually, how fast do they rise? Most importantly, how long do they stay elevated for? After studying that, you'll see it's usually a period of 2 years, and then they will tend to come down. So it's important, I think, to educate ourselves on that. And then also there are some people out there who are doing good work on understanding what are the demographics in Canada. We obviously have an aging population. What will that mean for interest rates a long time? Usually it means lower interest rates. But again, the more you learn, the more curious you are. I think you'll enjoy the stuff more and have a better grasp of things. But Arjun, last question on the MIC is for people who are wanting to learn more about MICs in general and are trying to navigate the landscape, what are the top 3 questions you would ask any MIC before investing?
I would look at management track record. I would look at experience in the industry. So, when assessing management, you have to look at several factors. You have to look at oversight. Do they have a bank facility? Have they qualified for that type of facility from the bank? Because the banks require reporting monthly. So you know that there's oversight there. Who are their auditors, right? Who have they chosen to invest their funds in, or the funds in, to provide transparency and accountability? So management is very important. The second factor is arrears. What is their arrears reporting? How do they factor and how do they consider arrears? I was talking to some of the analysts at the BMO Alternative Lenders Conference, and they noted that some MICs don't report power of sales as arrears. They separate it out. So they categorize arrears, and then they separate out power of sales. So it's very important to understand that arrears are arrears, whether you're selling the property or you're not selling the property. If the borrower is not making the payments, or they haven't renewed, or they haven't paid out, they're in arrears. Mm-hmm. So whether it's a 30-day, 60-day window, it's very important to understand the impact of all that. And third is the redemption policy. How do I get my money out? What is my focus on how, MICs generally would have a shorter time frame than other real estate investments through LPs that are focused on development or value add, depending on the structure. But there's generally a holding period. So you should familiarize yourself with that holding period and understand when can I get access to my money? And have they ever held redemptions? Because that's important, right? Because if a MIC holds redemptions or suspends redemptions, that's generally not a good sign. So a lot of the news articles that you and I discussed, Yathan, over this period of time was where MICs were suspending redemptions, or they weren't able to meet redemptions, or their returns were 2 to 3%, and their arrears were ballooning during this period of time. So those are very important characteristics of a fund that will separate the decision between investing in the fund and not investing in the fund.
That's a great summary. Arjun, remind me, and if it's okay for me to ask, with New Haven, I think I had asked you this question. If somebody wanted to get their money back, you had given me a window. Was it 3 to 4 months or up to 6
days.
months? 120 days. Gotcha.
4 months. So we've not ever suspended redemptions during COVID, during the high interest rate environment. We've maintained our redemption policy, and we've honored our redemptions till today, and even up until today and going forward.
I also like to learn from how other people are navigating this landscape. Arjun, I know you are a pretty passionate person when it comes to investing your money. You have obviously your MIC that we've talked about today. You've got, various products on your shelf through integrated equities, which you invest in all of those. You invest in real estate, the markets, crypto. What is your strategy like going forward?
The one thing that from integrated equities side, I like real estate. I've always been a fan of real estate. Now running a business day to day, I don't necessarily have the time to hands-on invest in multifamily or value add projects or development projects. So what I've done is I've looked at partners who I would invest in, and having the exempt market dealer allows me to place those products on my shelf. There's 6 different investments, including our MEC, that provide a variety of different risk and return models, right? That span from anywhere from 6 to 8% to 20 to 25%. Now, obviously, each one of those products is adjusted for time period, for risk. And when I look at how I invest, I do have diversification into crypto. I do have diversification into equities and the markets. But my focus always and will remain in real estate because that's what I understand the best. Now, I've had several forays into the equities market where I've tried to manage it myself. And let me tell you, it has not turned out well for me. I have not been able to manage a stock portfolio very well simply because in order to do that, you have to have continuous research and access to the market. And yes, Arya. Hey, Arya Data has to finish this. And as soon as he's
It's
done,
okay. You know what? The girl's got to play some ball. It's all
she
good.
does,
We're in the
yeah,
tail
she
end.
has
Yeah.
you know what's funny is I specifically asked her, I'm like, okay, Data has to do this interview. So please, don't bounce the ball. And sure
It's
enough,
all good, man.
every opportunity she's had, she's
You should have
bounced.
told her to bounce the ball, and
Yeah,
then she
maybe
would do
that's
the opposite.
yeah,
Yeah, that next time do
exactly.
that. Yeah.
So, I was talking about the strategies and equities, and I think to remain on top of that market, you have to consistently be invested or be able to trust somebody to manage that for you. And what I've done is, I've gotten a advisor to put me into ETFs and other managed funds that I've researched, but historically have turned you know uh, a reasonable profit. And obviously, listening to your pod has obviously given me a lot of ideas as you represent a variety of different investments. So from my focus, obviously my focus is real estate. It's to stay within my strategy, and and then obviously diversify into other aspects, but make sure it's controlled in the sense that I'm not having to manage it myself, but I'm investing in trusted products that really provide value over the long term.
Last formal question, Arjun. What is the most valuable lesson that you have learned?
Transparency and integrity. And when times get hard, the only way to meet those challenges is to meet them head on. And the more you try and cover and avoid the inevitable, the more it's going to hurt when you have to face it down the road. So I think from my perspective, the one thing that, us as a company at New Haven we met the challenge and adversity head on. And sure, we took some hits over that period of time. But today, I'm thankful we did what we did because we're much better off today because of it. So that would be the most important lesson. And over the last 3 years, I've learned more about the industry, about real estate, than the previous 12 years or 15 years prior to that. Because calm seas don't make a good sailor, right? You have to face adversity to learn how to adapt and adjust during times like this.
Arjun, where can people learn more about you, New Haven, and integrated equities?
We have our websites that you can have access to. We have an investor portal. You're able to reach out. Feel free to reach out to me. If you want, reach out to Yathin. He'll connect you as well. And I'm on LinkedIn. If anyone ever has any questions, feel free to reach out. I'm always
We'll
open
have
for
all that.
discussion.
Yeah, absolutely. We'll have all that in the show notes. And then if you're wanting to take it to the next level, Sweatpants World Tour on Instagram. Did you come up with that yourself? The Sweatpants World Tour?
No, a friend of mine, Anand, came up with it because
Okay.
what he did was he saw me in different countries, but the only thing that remained consistent was I was wearing sweatpants in each one of the photos. So he
I
coined
love
the
it.
phrase
Yeah.
Sweatpants World Tour, and I've used it today because I thought it was pretty funny.
Arjun, Thanks again for coming on the show, man, and thank you for being so candid and taking the time to answer all the tough questions. I think it goes a long way. I learn something every time. It's always a pleasure.
Yeah, it's great to be here. Thanks for having me, Ethan. And honestly, I look forward to playing golf with you soon.
All right, man. Take care. So, guys, I want to take a minute to offer my perspective on something that I read about this week. So, the quote that I came across was that burnout happens because people are spending too much time and too much energy on jobs that they frankly do not care about. When I look at this quote, it's really hard to argue at face value. If people don't care about their jobs, there's a very high chance that you will experience burnout. We all need to work though. We all have to have some sort of job. So that care aspect, how do we elevate that so that we enjoy our jobs a bit more? I think a lot of it boils down to autonomy. Let me give you a little bit of an example because I think there's ample evidence out there that when people have autonomy, which the dictionary defines as being able to function free from external control or influence, when people have this in their jobs, they tend to enjoy their jobs more. I learned a bit more about the importance of autonomy when I was listening to a really interesting video this week on a company called Constellation Software. Some of you may invest in this company. The ticker is CSW. The video focused on the founder, Mark Leonard. For those of you who don't know much about Mark Leonard, he is widely felt to be, alongside Warren Buffett, as one of the best capital allocators of all time. He would basically go out and buy companies, and even after he bought companies under the Constellation Software umbrella, he would allow the management teams of those companies to function as they would. He would give them so much autonomy because he realized that this allowed those companies to function optimally. The teams were cohesive and they performed really, really well. So how do we bring this into medicine, this concept of autonomy? I fully realize that in many areas of medicine, it can be really difficult to have autonomy because frankly, the system may prevent you from giving your very best on a certain day. You may have resource constraints, personnel constraints, but I do think there is one way forward. And I think this is through constant acquisition of knowledge, deep learning, and expertise. Let me try and give you an example. So I had a colleague in my practice. He's unfortunately no longer with us now, but I will name drop him because he's a really good guy. Patrick Kennedy. He was an interventional radiologist with our group at North York General Hospital. Patrick, in his fellowship, learned the art and skill of radial access for his arterial procedures. So when he came to our hospital, all of his arterial procedures were through radial access rather than going through the groin. This was huge because it meant faster recovery time for patients and far fewer complications. He was the only guy in our hospital providing this service. Patients loved it, their families loved it, the referring physicians loved it, and before we knew it, Patrick was not only the go-to guy, but he was starting to teach other people this technique because it was very, very sought after. So when I think a bit more carefully about our journey through medicine, which can be a very long one, I think there are plenty of opportunities along the way where we can acquire this knowledge and become experts in a certain area, whether it's in residency, maybe in your fellowship, or maybe in your early staff years. And it doesn't necessarily have to be something procedure related. It could be theoretical. It could be knowledge based. Think about it. You acquire this knowledge, you become an expert in a certain area or a procedure, and then maybe you go to practice in a smaller area where the people in that center or that hospital, they don't have access to this knowledge or this way of practicing. They don't have access to this procedure. All of a sudden, you are the go-to individual and you have the ability to practice as you wish and teach people along the way. You become the go-to individual. Your opinion is sought and you are appreciated. You are all of a sudden practicing with a bit more autonomy. And as my journey has evolved, I've realized that I'm a very curious person. I love to learn and I love to teach. And I hope that's evident on the podcast. And now what I'm trying to do is I'm trying to translate this over to my medical practice. So 7 months ago, I took on the role of being the Director of Education for the Department of Radiology at our hospital, North York General Hospital. So we get a lot of medical students and residents who will come and rotate with us on a monthly basis. I get a chance to supervise the rotations. I get a chance to be a mentor. I get a chance to teach and really try and optimize that training experience in a busy community hospital. It's a truly wonderful experience, and I do want to give a shout out to the residents who nominated me for a teaching award. Earlier this year, I won my first teaching award. I was very humbled by that. I was very grateful for that. And you guys keep me on my toes. You guys, in fact, make my day-to-day better. And it's really up to me to make sure that your learning at a community hospital is enhanced as much as it can be. So I try to give all the residents a mock oral exam. So far, it's well received, and we'll see where this goes. But for myself, I've realized where my interests lie. I've realized what I'm passionate about. And what I'm setting out to do now is to ensure that radiology education across the board for medical students and residents within and outside radiology is optimized, because I do think there is a long way to go. And I want to make sure that I'm finding the best ways to teach and the best ways to communicate with trainees, especially in a busy community hospital setting. So going forward, I do plan to make this area my focus, hopefully my area of expertise. And one thing that I am noticing with time is that it's helping me enjoy my job more, which is truly a wonderful feeling. So I do believe that one of the fastest ways to enjoying work more with a bit more autonomy is through acquiring knowledge, deep learning, and expertise. Thank you so much for tuning in again. We'll see you in a few weeks' time. Stay well, stay savvy.